Hi, I'm Rob.
And I'm Rob.
And this is Ask Rob and Rob.
Hey everyone, welcome to Ask Rob and Rob, the show where you ask the questions and we give the answers. And sometimes you may have a question that you're just desperate to get answered, and luckily this week we're able to do just that. It's been a big change in the property world the last few days, but don't worry, we've got you covered.
Yes, we do. So if you have a question, time sensitive or not, just give us a call. 013 808 00035. That's 013 808 00035. Or you can go to thepropertyhub.net/ask and send us a message that way instead. So let's have a listen to this very timely question. This is Hannah in Cambridge.
Hey Rob and Rob, it's Hannah here from Cambridge. Just wanted to say thanks a lot for the podcast and all the stuff you guys do. It's really, really helped me. So obviously last week the Bank of England raised the interest rate, which has taken me a little bit by surprise. I have 3 buy-to-lets. One I've just put on a 2-year fixed. The second is due for renewal at the end of the year. And the third is on a tracker. Like I said, this has kind of taken me by surprise. So I'm feeling a little bit overwhelmed and quite nervous. What should I do?
Well, thank you, Hannah. Great question. And Rob, I'm prepared to talk about this, but I think you should go first because I feel you're responsible. Maybe not responsible, but you told us this wasn't going to happen.
Well, yeah, no wonder Hannah from Cambridge was surprised because I've said something that's turned out not to be true. The first time this has ever happened, and so clearly has rocked Hannah's world.
Next week we get Rob's wife on to disagree.
That's a much longer podcast. So, the background to this is in our predictions episode back at the start of this year, I made the bold and, as it turns out, foolish prediction that the Bank of England would not raise the base rate in 2018. I was feeling very iffy about this a couple of months ago. But to be fair, Rob, neither of us thought it was going to happen this month.
That is fair, Rob. I had no idea this was going to happen. Yes, I saw it was interest rate day. And yes, I dismissed it immediately. I thought, this isn't going to happen. We just aren't ready for this. It turns out I too was very wrong. But it's happened. So, should Hannah be worried?
Well, other than rocking her faith in our predictions, which is a bit of a worry, the base rate rise itself, I think, is a bit of a nothing. And every time there's a change, all the papers come out with their stories about how will this affect homeowners, what does this mean for savers, and all that kind of thing. And you could kind of tell this time that they were really scrambling around trying to find something to say about the impact that it will have, because the answer is pretty much nothing. So it's a 1/4 point rise. To put that into context, if you've got an interest-only mortgage of £100,000, it's going to increase your monthly payments by £12.50. So unless you've got insane amounts of borrowing on razor-thin margins, it's not going to make a lot of difference. If you've got a repayment mortgage, then of course it's going to increase it a little bit more. There's also not going to be all that many people affected because anyone who's taken out a mortgage recently will have it on a fixed rate, and rates have been so low for such a long time, it's been very obvious that rates can't really get much lower and deals can't get a whole lot better. So there's been a lot of time to fix, and we've talked on Ask Rob and Rob in the past about the benefits and potential drawbacks of fixing. So, Rob, I'd say that it's interesting that we finally had a rise after such a long time. And it's interesting as well that it was unanimous, which I don't think we were expecting, especially because we didn't think it would happen at all. But in terms of short-term impact, very little, I'd say.
So this has happened. What's next? Many more rate rises? Well, on reflection and speaking to a few people about this after the event itself, I think that this move has been done purely for Brexit. And it gives the Bank of England somewhere to go after Brexit's taken place. Because after Brexit, whatever happens, and I mean whatever happens, there's going to be some fallout to it because some people will be unhappy. So whichever way it goes, the Bank of England need something in their toolbox to be able to help out. And really, they haven't got much in that toolbox except interest rates. Now, if they need to reduce interest rates again, well, they were so low that they didn't really have anywhere to go. So by raising them a little, it gives them a little bit of room to breathe and make a difference if needed. So it may mean that they raise them slightly more again if they can for the years out if they think they can get away with it. But what I don't think this is the Bank of England starting to raise them consistently. I think it's just a Brexit play. We'll see. We should learn, Rob, and know that predictions can cost us. But really, when you look at it and you analyse it, that seems to make the most sense to me.
Yeah, the risk of getting myself into more trouble. I think if there's going to be another change this year, it's more likely to be back down than it is up. I'm not saying there is going to be a change, but I think if there is one, then going back down is more likely. Because it's a pretty poor reflection on the state of the economy, really, if after 9 years we're freaking out about trying to get it back up to 0.75%. You're absolutely right, Rob. The bank needs to give itself some wiggle room. The whole point is that when the economy runs into trouble, you cut interest rates to stimulate the economy. We're a decade on from the last crash. Things should have recovered by now to the point that interest rates are higher and the economy can take it, which means that when things crash again, which will inevitably happen at some point, you've actually got something you can do about it. Things are still a bit dicey at the moment. We've been saying for quite a while that we think interest rates are going to stay relatively low for a long time. And that's been backed up by a report that came out from the Bank of England at the same time. They brought out an inflation report, which is not exactly the easiest of reading. But what it boils down to is that they think the new normal, effectively, for interest rates is going to be in the region of 2 to 3%. So eventually, they see the base rate in the medium to long term getting up to 2 to 3%, rather than the 5%-ish that we are historically used to. Now, of course, things change. It's not going to be that way forever, but they certainly don't see it going any higher than that anytime soon. So that's good news if you're looking for a bit of capital growth, and you don't need to worry about your borrowing too much. Of course, you need to have plenty of room for manoeuvre. But what we're saying is that this rise isn't just the tip of the iceberg. We're not going to see quick and constant raises all the way back up to 5% or anything like that anytime soon.
So Hannah, let's help you out. You've got those 3 mortgages in different stages, so let's work through them. So first of all, you've got the property you've got on a 2-year fix, and you've recently put it on that 2-year fix. No change. Don't worry, that's locked in. That isn't going anywhere. The rate you're paying today is the rate you'll pay for the next 2 years. So relax on that one. The second is due for renewal at the end of this year. And just wait and see. There's no need to panic right now. The mortgage market will be adjusting their products as we speak, and that'll all settle down in a few weeks. You may want to start a conversation with a broker in the next month or two, so you're ahead of the game. But if interest rates go up again this year, it will only be by another 0.25%. And as Rob said, it's more likely to go down and up. So don't panic. Even if it goes up by 0.25% more, if it's a buy-to-let mortgage, it isn't going to change things by a great deal. And the third mortgage that you've got on a tracker, well, as Rob said, it will rise and by about £12.50 for every 100,000. But even if you've got a £200,000 mortgage, £25 shouldn't smash your cash flow. There are stress tests now done by the mortgage companies, so you still should have a very healthy cash flow. So while you may not want to pay a few quid out extra every month, it's not make or break stuff. So while it makes a lot of headlines, and this is universal advice for all property investors, relax. It seems very dramatic because it has happened a lot recently, but actually in the grand scheme of things, it's okay and it's probably needed. So I think we put that to bed, Rob. But if the Liverpool property market crashes after me bigging it up at the beginning of the year, then I think I'm going to stop podcasting.
Well, hopefully that'll be the only dent made in our predictions this year. Everything else seems to be going to plan at the moment. So thank you, Hannah, for that question. I hope that helps. If you've got a question of your own, then let us know. 013 808 0035 or go to thepropertyhub.net/ask. We'll leave you for now, but we'll be back on Thursday with another episode of the Property Podcast, and it's one you won't want to miss. We will see you then. Bye-bye.
Bye-bye.